Hi, I'm Paul Kimmel. In this chapter, we're going to talk about financial reporting issues for merchandisers. You often hear business people talk about the need to focus on the bottom line. In accounting, the bottom line is net income. To increase net income, you need to understand the components of net income. That is, what are all of the activities that result in the bottom line? Identifying the components allows you to identify the areas where you are already doing well and areas where you can improve. Merchandisers like Amazon, Best Buy, and Target prepare income statements in a way that enables them to evaluate their main activities. They start with gross profit. Gross profit is the difference between sales revenue and cost of goods sold. That is, it's the difference between what you pay your suppliers and the price that you're able to sell the goods to your customers for. Sometimes merchandisers must cut their selling price in order to sell their goods. This drives down their gross profit. When gross profit declines, companies must take steps such as reducing their operating costs in order to maintain their profitability. Once you are familiar with the income statement presented in this chapter, those steps will become far more intuitive. If you want to focus on net income, you need to focus on the components of net income. This chapter will show you how.
In respect to profit margin, it's very important for us to monitor because it costs more for us to make our product. Using organic milk and cream is very expensive. So we make sure we keep our operational expenses low so that we can keep making our ice cream. I can do that a couple different ways. One is to monitor my staffing numbers, make sure that they're in line with the amount of people we have coming through the door. And then I can also monitor waste, which is very important, to make sure that we're using every last inch of product so that if we have cookies left over from the day before, we can turn them into an ice cream sandwich and there's absolutely no waste that way. We also monitor the product itself as it's being produced to make sure everybody's following the recipe the way they are supposed to. We also have found ways to keep our energy bills low. And we also use social media. We keep our advertising budget in line by using whatever is free, and that would be social media.
The purpose of this problem is to record transactions for a merchandiser using a perpetual inventory system. The first transaction occurred on June 1st. Where they purchased goods on account for $2,320, including freight, terms 210 net 30. Again, that means that they get a 2% discount if they pay within 10 days, otherwise they need to pay within 30 days. So to record this, we will enter the date, June 1st, and the account is inventory debited. And the amount is $23.20, and it was on account, so we will credit accounts payable. On June 3rd, they sold books on account for $21.90, and the cost of those goods was $8.20. So we enter the date, June 3rd. To record a sale under a perpetual system, we have to make two entries. The first entry records the receivable and sales revenue, so we'll debit accounts receivable for the selling price of $21.90, and we will credit sales revenue, and again that was for the selling price $21.90. The second part of this entry involves the cost of goods sold. So we debit cost of goods sold, and that cost was $820, and we remove that inventory from the company's books. The third entry occurred on the 6th. They received a $60 credit for goods returned to Carlin Publishers. And so to record this, we enter the date, and what happens here now is we purchased those goods on the 1st, and when we did, notice that we credited accounts payable. So now, if we're getting a credit, the amount that we owe that supplier is reduced, and so we debit accounts payable to show a decline in the amount that we owe them, and then we also reduce the inventory account. And that amount was for $60. Then on the 9th, we pay Carlin. Again, Carlin was the supplier that we purchased goods from on the 1st. So now we're going to pay them. And so let's first look at the accounts that are affected. So the accounts that are affected would be, if we're paying off an account, we're going to debit accounts payable. We're also going to be crediting cash because we're paying off this balance. And then if you look at the information above regarding that, you see that it was purchased on account terms 210 net 30. That was on the 1st, and we're paying this off on the 9th, so we're within the discount period. So we'll be taking a discount which results in a credit to the inventory account because it's a reduction in our cost of the inventory. Now let's look at the amounts. We can see that originally we recorded accounts payable at $23.20 on June 1st. Then on June 6th, we debited accounts payable related to that supplier. So the balance in accounts payable now would be $23.20 minus $60, which is $22.60. Next, let's figure out the amount of the discount. The terms were 210 net 30. 2% of $22.60 is $45. And so we credit inventory for $45. And so then the difference, $22.60 minus the $45 discount, is the amount we actually pay in cash, which is $22.15. On June 15th, the company received payment in full from Goldschmidt Bookstore.
No, that's funny.
The company sells to all of its customers at 210 net 30. And so the customers are supposed to pay within 10 days to get the discount. Since we sold to Goldschmidt on the 3rd and today is the 15th, they did not pay within the discount period, so they won't be receiving a discount. So to record this, we record the date, we debit the receipt of cash, and we credit the accounts receivable account, and the amount in this case is the full $21.90 because again they did not pay within the discount period. Next, on June 17th, we sold books on account to Town Crier for $21.90. The cost of merchandise was $8.20, and so we enter the date, June 17th. We debit accounts receivable. We credit sales revenue. The amount is $21.90. We also record a debit to cost of goods sold and a credit to inventory, and that was for $8.20. On the 20th, we purchased goods on account for $8.20, terms $215 net 30. So we will debit inventory and we will credit accounts payable. On June 24th, the company received payment in full from Town Crier. So the accounts that are going to be affected will be, we know that we will be debiting cash for the receipt of cash. We know that in this particular case, The sale to Town Crier took place on the 17th. Today is the 24th, so that's within the 10-day discount period. So we know that we are going to be granting a sales discount, and so we will end up debiting that, and we will credit accounts receivable. So let's start with the credit to accounts receivable. The amount owed to us, or according to the balance in accounts receivable, was $21.90. You can see above here that when we recorded the sale, we recorded a debit of $21.90. There hasn't been anything else since then that affected that, and so we will credit accounts receivable for $21.90. Next, we need to determine the amount of the discount. The terms are 210 net 30, so 2% of $2,190 is $44, and so the difference is the amount of cash we receive, which is $21.46. On June 26th, we paid Good Books Publisher in full. And so the amount that we owed Good Books Publisher originally, when we purchased it, we paid $820. And so we can see above that when we purchased it, we had an accounts payable for $820. And so now we will debit accounts payable. Okay, so that's one of the accounts that's going to be affected. We also know that we're going to be giving up cash, so we will end up crediting cash. And then the other thing is if you look back at that purchase, the terms were $215 net 30, and that occurred on the 20th. Now it's the 26th, so we're definitely within the discount period. So we will be taking a discount, and we record that purchase discount by reducing the amount recorded in the inventory account for the cost of the inventory. So the balance in the accounts payable account, we can see that we originally credited it for $820, so now when we're going to pay it off, we debit that account for $820. Next, let's figure out the amount of the discount. The terms when we purchased it were $215 net 30. And so the discount, the reduction in the cost of the inventory, is 2% of $820, which is $16. The difference is the amount we pay in cash, which is $804. On June 28th, we sold books on account to Emporia Bookstore for $1,100. The cost of the merchandise was $750. So we enter the date, June 28th. We sold the goods on account, and so we debit accounts receivable and we credit sales revenue. And the amount was $1,100. Then we also record the cost of goods sold related to this transaction. So we debit cost of goods sold and we credit inventory, and the amount was $750. Finally, on the 30th, we granted Emporia Bookstore a $210 credit for books returned that cost $90. And so to record a return by one of our customers, one way to think about this is that we're basically reversing out part of this previously recorded transaction. So if we look at the entries made on the 28th, first we're going to reverse out the sales entry. So we credited sales revenue, but rather than debit sales revenue, we use an offsetting account called sales returns and allowances, $210. And by using this separate account, it enables us to keep better track of our returns. And then we will take accounts receivable off the books for $210. Then we reverse out the cost of goods sold part of the entry. And so here we credited inventory, so to reverse it out, we'll debit inventory. and we will credit cost of goods sold, and the amount was $90.